Why most investors fail. The truth about handling losses. Investing is often painted as a road to financial freedom, yet a significant majority of investors fail to achieve their goals. What holds them back isn't a lack of technical expertise or access to opportunities. It's something far more subtle and dangerous: the inability to handle losses effectively. For risk managers who guide investors, teaching the art of managing losses is not just essential, it's transformative. This video will delve into why most investors fail, the psychological barriers they face, and actionable strategies risk managers can use to help their clients succeed. Let's dive in. Focusing on the reasons investors fail provides critical context for understanding the solution. The primary issue isn't picking the wrong stocks or funds, it's the inability to endure inevitable losses on their investments. Losses are unavoidable in investing. Markets fluctuate for various reasons: economic changes, political instability, sudden investor sentiment shifts. While these downturns are normal, improper reactions to losses can lead investors down a dangerous path. Some panic and sell prematurely, locking in losses that might have otherwise recovered. Others overreact by doubling their investments recklessly, compounding their financial risk. The common denominator here is the emotional aspect of financial decision-making. Most investors approach losses with fear and unable to stay rational under pressure. This is where most failures begin. Knowing this, your role as a risk manager becomes vital, not just as a financial guide, but as a behavioral coach capable of instilling discipline and resilience in investors. To adequately address poor loss management, we must first understand the psychological traps that lead to poor decision-making. Behavioral economics has identified several emotional biases and mental habits that cause investors to falter. Loss aversion. This cognitive bias describes how people feel more pain from losses than pleasure from equivalent gains. For example, an investor losing $1,000 experiences significantly more distress than joy from gaining $1,000. 2. Fear and panic. Selling. When markets sink, fear takes over, prompting some investors to sell at the first sign of trouble. Instead of risking further losses, they lock in their defeat before checking to see if the market rebound is likely. 3. Overconfidence and revenge trades. On the flip side, some investors react to losses by taking impulsive risks. Motivated by the desire to win back what they lost, they double down on risky assets, often exacerbating their losses. Impatience and short-term thinking. Many modern investors expect quick returns. When losses hit, they abandon investments prematurely rather than playing the long game necessary for success. Losses trigger emotions, and emotions cloud judgment. Successful investing requires understanding these pitfalls and learning strategies to overcome them. What happens when losses aren't managed well? The consequences can be disastrous and extend beyond the immediate monetary impact. Let's explore the reasons why poor reactions to losses can set investors on a losing trajectory. Permanent losses. Panic selling causes investors to lock in losses that might have been temporary. Historically, markets recover over time, and those who stay invested often come out ahead. Increased risk exposure. By doubling down impulsively on failing or high-risk investments, investors create vulnerabilities in their portfolios that may lead to greater damage. 3. Erosion of confidence. Investors who repeatedly mishandle losses lose faith in their own ability to make decisions. This fear of failing again often causes them to exit investing entirely. The cumulative effects of these outcomes explain why so many investors fall short of their financial goals. Managing losses is not just about avoiding financial pitfalls. It's about ensuring an investor's sustainability, confidence, and long-term success. One of the most powerful mindset changes risk managers can teach their clients is to reframe losses as opportunities for growth. Losses are not anomalies. They are an integral part of the investment process. Every successful investor, from Warren Buffett to Peter Lynch, has faced losses. What sets them apart is their approach. Instead of seeing losses as catastrophic failures, they view setbacks as critical learning moments. This mindset change removes the emotional charge from losses, allowing decisions to be guided by logic and strategy rather than fear or frustration. By embracing losses as part of the process, clients can focus on long-term objectives rather than reacting emotionally to short-term trends. Teaching investors to cultivate resilience will help them anchor themselves in broader goals, turning losses into stepping stones for improvement. As risk managers, your training can empower investors by giving them tools and systems to handle losses effectively. Below are practical, easy-to-follow strategies you can introduce to help investors stay disciplined in challenging times. Help investors establish clear risk-reward limits before they invest. Encouraging them to identify how much risk they are willing and able to take establishes guidelines that minimize emotional decision-making during market turbulence. Introduce stop-loss thresholds, a critical risk management tool. Setting automated sell orders at predetermined loss points helps investors avoid knee-jerk decisions during downturns while protecting their portfolios from excessive losses. Discuss the importance of diversification. Explain to investors how spreading funds across various asset types reduces the impact of losses caused by any single investment's poor performance. Think stocks, bonds, real estate, and global markets. Teach your clients to rely on logic and data rather than gut instincts. Simulate hypothetical market downturns to show what staying invested might look like over time. Equip them with strategies to anticipate emotional triggers and build rational responses to volatility. Beyond tools, emphasize the principle of sticking with the plan, even when losses occur. The best-built strategies are useless without the discipline to follow through. A disciplined investor is far better equipped to manage turbulence. While most individuals focus on chasing returns, disciplined investors understand that managing downside risk is what enables long-term growth. Your role as a risk manager is to foster this mindset by building robust frameworks that investors can trust and follow consistently. Encourage clients to document their strategies and review them periodically. Frequent adherence to discipline safeguards against emotional decisions and keeps investors focused on their original goals. Real-world stories provide the perfect learning grounds for understanding the impact of loss management. Success story. Warren Buffett once famously stated, "Rule number 1, never lose money. Rule number 2, never forget rule number 1." Though losses are inevitable, Buffett's meticulous risk management drives consistency in performance. His strategy includes diversification and careful allocations, avoiding emotional pitfalls. Cautionary tale. The 2008 financial crisis exposed countless investors who failed to manage losses well. Many exited the market at its lowest point due to fear, watching from the sidelines as the market rebounded in the years that followed. This short-term reaction crushed their potential long-term gains. Highlighting both successful practices and cautionary mistakes reinforces the idea that managing losses is what separates successful investors from those who fail. Resilience is cultivated by keeping the broader picture in focus. The day-to-day market reality can feel overwhelming, but long-term investors know that time in the market is far more valuable than timing the market. Historical data consistently shows markets recover from downturns, rewarding patient investors. As a risk manager, preparing your clients to weather tough times doesn't only protect their financial investments, it builds emotional resilience. Equip them with the tools, mindset, and techniques needed to stay in the game, no matter the challenges that arise. To instill confidence, share data with your clients. Investors tend to respond better to insights rooted in evidence. For example, include historical market rebounds post-financial crises, for example, gains following the 2008 crash. Discuss how a diversified portfolio historically mitigates losses. Present expert opinions on risk-reward thresholds to validate your training material. Building trust in practical systems backed by data ensures that investors rely less on emotion and more on proven strategies. Your role as a facilitator of investor education is as much about emotional guidance as it is about practical tools. Here are some techniques risk managers can apply when training investors. Simulate market scenarios. Conduct scenarios where participants experience losses in a safe, controlled setting to understand their reactions and learn better responses. Stress test portfolios. Help clients build resilient portfolios capable of withstanding unexpected shocks. 3. Educate on self-awareness. Understanding their own tendencies, whether to panic or overreact, empowers investors to counteract these habits. In conclusion, the inability to manage losses is a defining reason why most investors fail. However, it doesn't have to be this way. With the right tools, mindset, and guidance from competent risk managers, investors can overcome psychological biases, stick to disciplined strategies, and turn setbacks into advantages. Encourage your clients to embrace the journey, losses and all, with clarity and confidence. Remind them that losses are temporary, but a disciplined, resilient approach creates lasting success. The path to financial independence isn't without its bumps, but together, we can ensure it's one worth staying on.